Hey guys, Dave Keller with the Market Misbehavior. Today we're going to analyze the chart of Tesla and answer the question, will Tesla break above $300? There's no denying the strength that we've seen in growth stocks. A lot of the videos we've posted recently on our channel have dealt with the overextended conditions on leadership names like Apple and Microsoft. Today in particular, on June 20th, you saw a move lower overall in risk assets, but one sector, consumer discretionary, was actually in the green, and one particular stock really led the way higher, and it's Tesla. Tesla and Rivian had a signed agreement related to the supercharging stations, and as a result, both stocks actually moved higher today. But what does the technical picture tell us about the chart of Tesla? We're going to look at it together here in a few moments and answer the question, will Tesla go above $300 a share? Before we get there, by the way, if you like this sort of thinking about technical analysis, investor psychology, market history, won't you subscribe to my channel? Also, give the video a like if you appreciate it. We would super appreciate that back. Put a comment below, yes or no, a thumbs up or thumbs down. Does Tesla break above $300 a share here in the coming weeks? Now let's look at the chart of Tesla, and the way I will basically set the stage for our discussion is to look at the last 2 years. My classic chart combines a daily open, high, low, close bar with the moving averages 50-day in blue, the 200-day moving average in red. Below there, and we have some other lines on here, notations, which we'll get to in a moment. Below there, we have the RSI, a classic measure of price momentum, and at the very bottom, relative strength, looking at this particular stock, Tesla, versus the benchmark, and I always use the SPY. So overall, what are the conditions with Tesla over the last 2 years? Well, Tesla topped out in November of 2021, while the S&P made a new high in January 2022. Tesla, along with many other stocks and a lot of breadth indicators, momentum indicators, actually made a lower peak in January and then rotated lower. But the first half of the year was actually okay. It wasn't selling off a ton. It was actually remaining fairly strong. Then things really accelerated to the downside, and the real difference between the S&P chart or the NASDAQ chart and Tesla, both of them made a new low in the first quarter, made another low in sort of May, June, but the S&P, the NASDAQ actually bottomed out in October and then rotated higher. Tesla actually continued and made a new low in January of 2023. That's why the relative performance was so negative in the fourth quarter of last year. From there, though, if you start the clock on January 1st of 2023, pretty decent year for Tesla. And you can see this sort of pullback pattern, what we might call a bull flag pattern in February, March, and April, and we underperformed. But overall, the trend has been fairly positive. So you've done well owning Tesla versus the S&P 500 so far in 2023. Now let's look at the price structure in a little bit more detail. If we take the high from November of 2022, take the low from January of 2023, we can apply the Fibonacci framework, which means once you've defined a high and a low, you can identify some potential resistance levels or support levels between those two extremes. And the classic levels are 38.2%, 61.8%. The 50% level is a secondary level, and a lot of people pay attention to that as well, so I like to include it on the chart here. So the 38.2% level is right around $221 a share. Now, how you use that is once we've bottomed out and start to rotate higher, that's when you apply the Fibonacci framework, and it gives you an upside objective, what we call a minimum upside objective. As we rally, you'd expect resistance right around 221. If you look, we got a hair away from 221, but did not quite get there. So that actually held as resistance in February. We rotated lower. We also stayed below a descending 200-day moving average. One of my mentors used to say, nothing good happens below the 200-day moving average, meaning you want to wait for stocks to recover above the 200-day, particularly things that have been in a downtrend for quite some time, because those bear market rallies can be super tempting. But once we get through the 200-day, that tells you there's enough of a rotation more to the bullish side that it's probably going to have some legs and potentially go further. So Tesla finally broke above its 200-day moving average at the last trading week in May, and from there we've rotated higher. 221 is that Fibonacci level. 219, we'll call it. 218 maybe was the high in February. So a couple weeks ago in early June, we actually broke above that first key resistance level. We'd also gotten above the 200-day moving average at the end of May, and so overall we're now in more of a bullish phase. Now what is happening? Well, now we're reaching that question mark point, $300 a share. Now the reason why I think the argument can be made against going much above $300 a share is because that is the next big Fibonacci level. Now that we've broken above 221, the Fibonacci framework would tell you 295 should be sort of that next key resistance level. Now, what I always am interested in is when we have what's called a confluence of resistance. I did a video last week talking about a confluence of support. It's a very similar idea where you have basically a confluence of resistance, a resistance level that different indicators with different calculations are all sort of in agreement that a particular level or particular range is going to be meaningful. So 295 is that Fibonacci level. If you look, the highs from August and September of last year are right around that same level. It's actually around 310, 315. So I would sort of generally group that 295 to 310, 315 range as this green shaded area. That's what I call a resistance range. So when I say, are we getting above 300, what I'm really doing is focusing on this green shaded area. That's what I'm really thinking about. The reason is because I think, years ago, if you read books by Edwards and McGee or John Murphy, a lot of these were written before decimalization, when a lot of stocks traded on eights, which means you could have a particular resistance level, $18.50. And you could have a reasonable expectation that the stock would literally hit that exact price level and then come down because there were only 8 steps between each dollar. Now, of course, we have stocks trading at sub pennies, which means having a particular level like 294.91 and having any reasonable expectation that that price point will be hit on the dot and then rotate lower, I think that's fantasy land in 2023. So I tend to think of support and resistance levels as more ranges and not particular levels. So when I'm saying, will Tesla get above 300, what I'm really saying is, will Tesla get above this 295 to 310 range? And that sort of encompasses the Fibonacci level, the highs from August and September. So another way to think of it, will Tesla get above its August 2022 highs? Worth noting, the S&P just did, right? That was a 4,300 level on the S&P 500. That actually has broken above. The NASDAQ has gotten above its August high. Does Tesla follow suit and do so as well? Now, one thing to think about, while the relative performance has been strong, as we mentioned earlier, the RSI is very overbought, very overextended. Current reading is just above 88. It's actually pretty rare to have the RSI that high and that close to 90. Actually, very rarely touches 90 for most stocks because that means not just that it's a volatile name, but it's showing extreme volatility relative to what it normally does. The last time the RSI was this high was back in October of 2021, which was the top. That's the all-time high in Tesla. So we're showing similar conditions now to the conditions we saw in October of 2021, where the stock actually made a new swing high and then accelerated to the upside. I think we're seeing that same thing here with the rotation up towards 300. You're seeing the relative strength really improve like we did back then, and you're seeing the momentum become extremely overbought. So what's the potential for us to get above 300, above 315, we'll call it? Let's bring in a little more data. One of the cool things you can do with technical analysis is really use it as a history lesson. Look back at when a stock like this has become this overbought and what's happened. So what I'm going to do is focus in on 80. So that this horizontal line right now is about an 80 level. So I'm showing you currently we're well above 80, around 88. This was the last time we were above 80 here at late 2021. But you can see a number of these other times when we were overbought and looked up and see what happened soon after. The reality is, going back to the beginning of 2020, becoming overbought, particularly with an RSI above 80, has actually been a pretty negative thing for Tesla. Whether the longer-term trend has continued like it did in the end of 2020, it was also a consolidation phase. This was a basing pattern, a coil pattern for about 4 months before the uptrend resumed. Here's the difference, though. In late 2019, you can see that Tesla was accelerating to the upside. It became extremely overbought and then just kept going, particularly in December of 2019. It became extremely overbought. It stayed with an RSI above 70 all the way till February, which ended up being the end of that move. So the reality is, while an extreme overbought condition like we see now in recent history has actually been a negative sign for Tesla, there are previous times, particularly in accelerated moves, where the stock will become overbought and stay overbought. That's why I always look for an RSI to come out of that overbought region. Look at when we became overbought and then the RSI goes back below 70. That's what often indicates that the uptrend is exhausted, that the move no longer has further upside beyond what we've seen so far. That takes us back to the current chart. I'll get rid of this guy. Now, what happens from here? So I would say, based on the conditions we're overbought, that tells me to be skeptical of further upside, but to follow the trends until they continue. At this point, because of that confluence of resistance from 295 to 310 to 315, I would say the likelihood of us getting above 315 at this point without a significant drawdown would be fairly unrealistic. However, What would tell us that that is actually playing out? I would be looking at RSI to see if the relative strength comes down. If the RSI goes below 70, that could be a big warning sign that this incredibly strong uptrend that we've seen in May and June might be alleviated. Similar thing to look for, by the way, with a lot of leadership names in the growth space that are overbought right now as well. The S&P it came out of the overbought region today at the close. The other thing is to look at whether the relative strength line turns down. One of the big benefits of stocks like Tesla is that they've allowed you to outperform the S&P. Or if the rotation starts to go down, if investors rotate into other parts of the market, maybe more cyclical leadership like energy and materials, more defensive leadership like utilities and consumer staples, that will probably provide a hit for Tesla because the conditions that would be good for those stocks are not going to be as good for a chart like Tesla. What do you think? Do you think Tesla gets above 300 in this cycle? Or technically, we're talking 295 to 310. Do we get above there without a major pullback happening? Let me know in the comments below. Thumbs up or thumbs down, and why. For Market Misbehavior, I'm Dave Keller. Take care. Have a good one.